Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO on the TSX Venture Exchange. Rainy Mountain Royalty Corp. is a Canadian-based mineral exploration project generator. The company currently holds multiple property interests in Ontario with joint venture partners and is seeking further joint venture partners for other drill-ready properties in our portfolio. For more information, please visit our website at rmroyalty.com or call me at 604-922-2030.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is home ownership consultant Ross Kay from thewealthyhomeowner.ca. Welcome back to the show, Ross.
And thanks for having me back, Jim.
Ross, this week the OECD published an income-to-house price ratio chart that placed Canada at the highest in the world. Do you believe Canada is the least affordable place to buy a home?
Yeah, no. It's the most ridiculous metrics of housing markets probably ever created, Jim. I mean, if you look at their methodology, so in other words, if you take the time to go back in and read how they analyze these things, it's clear that these guys are clueless. I mean, what other country in the world can a minimum wage, dual income family get a house bought and paid for by Canadian taxpayers? Okay? You can work at McDonald's in many parts of Canada today. And if you have two children, the Canadian Child Tax Benefit will fully fund your ownership cost of a single detached home. Now, I'm not just talking about some place out in the boonies, up in Nunavut or something like that, where, by the way, housing prices are quite expensive. I'm talking about a quality home in a quality town with quality schools, with quality healthcare systems. Because, of course, in Canada, we have to remember, healthcare is paid for. And the lower you are in the income ladder, the more benefits our society will give you if you take advantage of them. So that's where I would start that discussion when I hear these idiots at the OECD making these comments about the Canadian housing market, which then leads our politicians to start making irrational decisions about the housing market, which in turn causes stakeholders to capitalize on the irrational decisions of the politicians working in the housing market. It's just a plethora of problems, Jim. The way that you measure affordability in your housing stock, it needs to be measured in three different places. You have your initial acquisition. So you have, technically, this is a first-time buyer. Now, when you're measuring first-time buyers, you got to be sure that you throw out foreign buyers. Because first-time buyers in Canada include foreign buyers, which means if you're measuring the Vancouver real estate market, you're measuring people who are buying $4, $5, $6 million homes as a first-time home purchase. You've got to throw those out. You've got to look at it. What is the average Canadian buying as a first-time home? Well, in Vancouver, it's going to be a one-bedroom condominium somewhere in a high-rise. They're going to pay an exorbitant per square footage price to get into the housing market. In many cases, it still may be lower than renting a comparable unit, but they will get into the housing market if they so decide. Now, of course, we don't recommend getting into a housing market while it's correcting. But that being said, people made these decisions over the last couple of years, and now they've got to weather the storm. So after you do the calculation for those folks, it is a totally different calculation, affordability, than what income to debt ratios are. Because income to debt ratios only measure half of the mortgage financing situation. I mean, back in 1990, when houses were, less than half what they are today, about a third of what they are today, home buyers were spending double the mortgage interest payable than what they're spending today. If you purchased a $100,000 house back in 1990, you took out a $100,000 mortgage, you were expecting to pay, over the lifetime of that mortgage, 25 years, before you paid it off, over $200,000 in mortgage payments. Well, you're not even paying even remotely close to that now. So now you pay more principal and less mortgage interest. It's a balancing act. It's a scale. These discussions don't take that into play. What these discussions do is this, Jim. They take the average selling price of a home. So the prices that they use in these charts by the OECD vary from country to country. It is not a consistent measure of house price. In other words, it right off the bat puts Canada at a disadvantage when you're measuring in 2017, 18, 19, because you're measuring at peak house price illusion. It's when trade-up buyers are functioning at their highest levels, which makes everybody believe housing prices are rising more than they really are. It's just simply a function of first-time buyers not buying. And then the following month, the way that realtors sell houses, they inflate the price, whatever the local real estate board said, housing prices went up, even though the price of homes didn't change in 30 days. It's a self-fulfilling prophecy. In Canada, they use the average selling price. Well, the Canadian average selling price that they're using, or the Terranet National Bank House Price Index, what they're using, or the MLS HPI, what they're using, is skewed by the sales mix. It is not a consistent measure of house price change, because the only houses that are selling that they can use in their index is constantly shifting. When there's fewer first-time buyers, initial acquisitions taking place, and there was more trade-up buyers taking place, all of those indexes and the average disproportionately reflects trade-up buyers instead of first-time buyers. So the housing price gains are higher. So the index that you use for Canada reflects a higher purchase price than what is used for other parts of the world, other countries. Then on top of that, they take the median income. Well, the median income never buys the average home. So why are you doing a calculation based on it? The median income is basically an entry-level buyer in Canada, initial acquisition. The median income, which we're looking at 50%, we've got about a 70% home ownership rate in this country, meaning 70 to 50% first-time buyer, category of first-time buyers, or primary trades if they've been in a house for a few years, always have a lower income level, so they're buying cheaper homes. They're not buying the average home. The average home moves. What is the average home? What was the average home in 2013 in Canada? Did not even look remotely the same as the average home being purchased in the spring of 2016, because in the spring of 2016, it was being dominated by single detached homes in Greater Vancouver, which no way it resembled the following year in the spring of 2017, when the number of homes that were being sold was disproportionately in the Toronto real estate single detached market. So the home looked totally different. If a large percentage of the home is located in Toronto versus Vancouver. And now 2019, that both of those markets have slowed down, and the Montreal market has stayed basically level to what it was. I mean, it increases at such a slow pace, it really doesn't matter. But that said, its share of sales has drastically increased. So now that average home is no longer located in central Canada, out to Vancouver, into Toronto. It's now in Montreal. It isn't even the same home, because all of these house price metrics are natural. Their methodology only measures the homes that are being purchased. So when a housing market in one part of the country cools down, the number of sales that are taking place there reduces. When a housing market in another part of the country speeds up, there's more sales there, so the average selling price, the average home, is located closer to that city. These house price metrics don't take that into consideration at all. So we've got an income calculation which is wrong. We have a average house price that is wrong. And then they don't take into consideration other factors that affect affordability. So in Canada, we have a publicly funded healthcare system. And what that means is you will not lose your home because you get cancer. Okay? That's what the difference is in this country. In the United States, you can have health insurance. But if you get cancer, your ability to continue to own your home decreases. Your risk of foreclosure increases. That doesn't happen in Canada in the vast majority of cases. I know there's always outlier folks. And this OECD report is basically recording an outlier. They don't record the normal person. The normal family, the normal median income family is buying an entry-level home. They're not buying the average home. The median income family is not even buying the median home, because the median priced home in Canada is actually your second or third trade. Your average home shifts between the third and the fifth trade of homes that you'll own over your lifetime. Again, none of these discussions take place. Property taxes, another myth. In Vancouver, if you own $1 million home, you only pay $2,500 a year in property taxes. If you bought that same home, forget about the United States, just over in Calgary, you're going to pay $8,500. That's a $6,000 a year after-tax savings in Vancouver, making the Vancouver and the Calgary market totally uncomparable. You can't compare the two markets without adding in the property tax variable. If you went to Windsor, where property taxes, or Hamilton, where your property taxes on $1 million home are $12,000 a year, it's $10,000 a year difference owning $1 million home in Hamilton than $1 million home in Vancouver. And that's after-tax money. Property taxes are paid with after-tax money. That means you probably got to earn, to buy $1 million home, an extra $20,000 a year just to buy that $1 million home in Hamilton versus Vancouver. They don't calculate that in their affordability calculation. What age's house are these people buying? Is the housing stock in Canada newer than the housing stock in Slovenia? I'll bet you it is. And I'll bet you the quality of home that you're buying for your home buying dollar in Canada is better than the quality of home you're buying in Slovenia. So the affordability reduces in Canada because you don't have to spend as much money keeping the home up to snuff, keeping its place in the housing stock. If you buy a brand new home, in terms of affordability, let's be 100% honest here. A brand new home for the first 12 years of ownership really has no maintenance, repair, and renovation costs. You may want to put a fence up. You may want to blacktop the driveway. You may want to caulk the windows. You may want to finish the basement. But those are all your choices. You don't have to put in new windows. You don't have to put on a new roof. You don't have to put in a new driveway. You don't have to put in a new kitchen. So these affordability discussions need to include the age of the house that you're buying. And when you throw all of those variables into the mix in creating an affordability chart, you see that these OECD reports are just hogwash. The fact of the matter is, the median home in Canada is priced at under $400,000 today. It was under $375,000 in January. But now a whole bunch of expensive homes have come listed in Canada, which skews your median upwards of $25,000. The fact of the matter is, there are still over 45% of the homes available today are under $375,000 in Canada. Okay, so if that home, the median home, is normally purchased with a 22% down payment, that means the median income family The double income earner at McDonald's can afford it. If it's a first-time buyer, they can't. So they're going to spend less on a home if they only earn minimum wage. Maybe they're going to rent, save their down payment. The fact of the matter is, you should not be buying a house into a correcting housing market. So I am not here on the show trying to encourage people to go out and buy a home when I'm telling them that the way housing markets are discussed, affordability is discussed, is wrong. I'm telling you, these are all wrong, but you still shouldn't go out and buy a house today. What you need to do is sit down and you need to get all of these measures about the cost of owning a home. Because I can promise every listener across Canada, it costs you today, at today's prices, no more to buy the average home that is selling today, being purchased today in Canada in the month of May, than it did in the month of May of 1989. It costs you no more money. They are just as affordable today as they were back then. But think about it. Doesn't that make sense, Jim? If Canadians are still buying homes, if Canadians are still booking mortgages, if Canadians are still moving up the property ladder, if our home ownership rate is still around 70%, the same as it was in the late 1980s, early 1990s, doesn't that mean that affordability probably is close to what it was? The only difference is how you approach the numbers. Look, you are never going to own a single detached home in Kitsilano, Howe Sound, in Vancouver, in 2019 and beyond. The only people who are going to be able to own those homes are the top 2% of earners in this country. And they're only going to, most of those people are only going to get there by working their way up the property ladder. This is no different than saying an average income earner in this country should be able to buy a luxury mansion in Beverly Hills. It would be an absurd comment to make. Well, in Canada, our Beverly Hills are single detached homes in Vancouver and single detached homes right in the primary areas of the city of Toronto. There are also some along the lake shore of Lake Ontario in Ontario. There are some along the ocean side in British Columbia. But those are the extremely expensive homes in Canada, which in 2019 and beyond will never be owned by just a regular family. Which is why we need to put pressure on our politicians to build out single detached homes in the old sprawling philosophy that Canada used to embrace. Because you will never own the vast majority of Canadians who want to live close to Vancouver or close to Toronto, maybe within those two cities, will never own a single detached home. It won't happen. You're going to live in a condo. Your kids, if you have kids, are going to grow up on concrete. You are not going to breathe fresh air. Your breezes are going to be constricted by buildings around you. You are not going to have trees to lay out under. You are not going to be able to have a garden to grow your own fruits and vegetables in, get exercise in, grow older in. Have you ever seen a gardener, Jim? I mean, they are healthy people because they have a backyard that they can go out and exercise in. And these affordability discussions by places like the OECD, the IMF, ratings agencies, the banks, everybody who's whining, Generation Squeeze out in British Columbia, only mess up the discussion. It stops a proactive solution from taking place. That proactive solution is governments need to approve building envelopes for single detached homes as close to the large urban cities as possible. The builders will do the rest.
We'll have more with Ross Kay right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Grand Portage Resources' Herbert Gold Project in southeast Alaska highlights increased gold resource, indicated and inferred, of 860,000 ounces, in excess of 10 grams per ton gold. Expansion drilling is planned on the Herbert Gold property for the summer of 2019. Grand Portage Resources trading symbols are GPG on the TSX Venture, GPTRF on the OTCQB, and GPB on Frankfurt. For more information, please visit our website, grandportage.com.
Welcome back. We're speaking with Ross Kay. Ross, later this week, the Bank of Canada will give their interest rate decision. Your previous forecasts have been correct. What do you think is going to happen this time?
Okay, so this time around, again, it's very simple. They're not going to do anything. They're just going to hold the rates. Why? Why are they going to hold the rates? They're going to hold the rates because economists across Canada are telling them that the housing market in Toronto is stabilized. The only outlier they're going to claim is Vancouver, which they claim now is correct. Okay? Well, I'll tell you, folks, the GTA is correcting identically to Vancouver. You can listen to whoever you want. I'm telling you, the data that we have, which is never wrong because it can't be wrong, is telling us those two markets are moving on the exact same plane. The Bank of Canada doesn't know that. They believe the bank economy. They believe their group of individuals, they get together and discuss about whether or not we should raise rates. They are looking at jobs reports that are based on a housing market from 2 years ago. That's how long we have said in the show over and over again. The lead time of a housing market is tremendous. If you look down at the United States right now, if you look at our shows, I think this was in 2016, the end of 2016. We did a show where we told everybody the U.S. housing market was over and the sales were going to start declining. Okay, well, guess what, folks? It took the 2 years, and here they are. You are reading a housing market years in advance. The Bank of Canada does not understand this. The Bank of Canada does not even know how to read its own charts on its own website. If you look at the Bank of Canada website and you look at mortgage debt and you look at their annual and 3-month year-over-year changes, percentage change, you'll see that from around 2003 to 2009, there was a straight-up rise in percentage change of mortgage debt. And then if you look from 2009, that point, to 2019, it is a downward trend in mortgage debt. Why? Why does the Bank of Canada not able to read their own data? Because they get information and they believe myths the same as everybody else does. It is impossible for Canadians to take on too much mortgage debt. Let me get this straight. It is impossible. The home lending infrastructure in Canada makes it impossible. Look, there'll always be outliers. There is always going to be fraud. There is going to always be a little bit of irrational decision-making by people who believe the housing market is going to go on forever. But these are all outliers. They don't impact the market. If you look at mortgage debt the way that we look at it, the government has had 2 years' notice to start to reduce mortgage rates if they were concerned about the economy. They have failed to act, which to us means they simply haven't read it. We said CIBC was going to underperform on their mortgage origination. On this show, I think 2 months ago when we're talking about bank earnings. Well, that is exactly what was reported. We didn't know which of the other banks were going to pick up on it. But as it turned out, it was TD and RBC. Now, TD should have been expected. RBC, we were a little bit surprised at. But you still could have made an educated guess had you taken the time to read those two stocks. Well, of course, what happened? Both of them reported more gain. Today, because TD and RBC increased their mortgage book at a time when mortgages being booked are dropping, that meant someone else had to take the hit. Well, as it turns out, it was Scotiabank, and their stock prices dropped today. So we are now 4 for 4 on the banks, with still 2 more to report. This is not complicated. All you need to do is read the mortgage origination data, and you know what's going to happen. Yes, you have to track mortgage rates being offered by those banks, how aggressive they are with their discounting, or if they're going after the mortgage brokerage market. But that's pretty simple to do. It's not complicated. But clearly the bank isn't doing that. What the bank is doing is listening to all these people who have missed every single call in the housing market since 2008. Every single call they've missed. You're looking at a group of economists from the banks who get together and discuss it with our governor and our bank economists, and they come out and they can't even see the drop in the continual linear drop in mortgage debt being booked by Canadians since 2009. They can't see it. Yet when we look at the chart, we can draw arrows on it, and any 6-year-old could tell you one arrow goes up and the other arrow goes down. This isn't complicated. So the bank, Jim, is going to come out and they're going to hold rates. Then what's going to happen is they're going to realize they've been caught later this year, and they're going to have to reduce rates. And then the realtors and the bankers and the mortgage brokers will all say, oh, this is going to turn the housing market around. Wrong. This is the pattern, the exact thing. And this is what's really, really, really bothersome here. I will be honest, this is bothersome. Polaz was at the Bank of Canada between 1980, during the years, like he was there, I mean longer than this, but he was there during these specific years, 1988 to 1992. He was there during that 4-year window. It's actually 5 years, excuse me. He watched what happened. He saw the mistakes. Your listeners probably don't understand that the great house price correction of Canada in the early 1990s, which lasted right on through till 2003, was caused by a rise in interest rates after an easing of interest rates had taken place in the 1 year prior. Interest rates got down to 9.75%, and then the bank raised them to 12.75%, ending the housing market. Another year later, they had dropped the rates back down again, but by then it was too late, because a housing market requires momentum to keep going forward. If you pull sales out of the market, the theory of the multiplicity of sales means it will continue to decrease. It takes a long time for a housing market to get stimulated again, for the velocity to start building back. And a simple drop in interest rate is not enough. You then have to take a long period of time for current owners to pay down home equity, which builds the amount of money they have available to purchase their next house as they move up the property ladder. That's why during the 90s, the length of time an existing owner was in their house far exceeded what we've seen over the last little while. Because over the last little while, not only were people paying down their mortgages at the most rapid rate in terms of dollars in history, but housing prices which naturally correlate to this mortgage pay down debt, cause a multiplicity of a home equity to take place. Now, we don't have a term for this, but what it means is that naturally, if you pay down your mortgage rate rapidly, housing prices also increase as rapidly, which is exactly what takes place because people are able to move up the property ladder quicker. The Bank of Canada does not have this. You can go to the Bank of Canada's website right now. You can search through their archive of reports. You will not find this most simplest housing market factor discussed in their website. So, what is the Bank of Canada going to do, Jim? They're going to hold rates the same. They're caught. They've let it go too long. They should have already started to soften rates if their concern was the economy. Now, my personal opinion is we have a housing correction that is needed. It is going to take place. Whether you let this current correction finish itself out or you try to delay it to get past the election, it isn't going to matter. The new government that is elected is going to bear the brunt of this, the damage, financial damage being done by correcting housing market. The same as the Liberals benefited from your rapid house price growth, and now the new government is being harmed by your house price deflation in Vancouver. The Ford government in Ontario. The election took place just as the housing correction was beginning. The Ford government in Ontario is going to have to deal with falling revenues because of a deflating housing market. The Bank of Canada has simply escalated the damage that is going to be done, because the damage that is delayed today will be intensified tomorrow. And that is why the Bank of Canada, if they're trying to offset this, and because of the changes to the mortgage lending infrastructure created by the institution of a variable gross debt service ratio, should probably be reducing their rates right now. This week, they should be reducing their posted rate, because that in turn would get the banks to drop their 5-year posted rate, which would allow home buyers to enter the market at a little bit quicker pace. There is no changes, Jim. There are no changes that can be made today to reverse the market. All they can do is offset the damage, delay the damage, and which in turn gives existing homeowners an opportunity to extract themselves from the situation they now find themselves in.
We'll have more with Ross Kay right after this.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp, MGI and the TSX Venture Exchange. A 2015 drill program on the LH property intersected several high-grade gold intersections, including 11 meters of 20.66 grams per ton gold. Additional drill targets on the LH property have been identified by a 2018 drone airborne magnetic survey to further evaluate a pyrrhotite-enriched gold-bearing system. Please visit our website at magnumgoldcorp.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Ross Kay. Ross, a listener asked, what's the difference between a housing crash and a house price correction? Because they couldn't find a proper definition of that.
Great point. Great question. There is no definition. You can check every periodical released by an economist, in a university, anywhere, an academic, anywhere in Canada, anywhere in North America, anywhere in the world. You will not find a definitive definition of a housing market correction and a housing market crash. It does not exist. You have a whole bunch of people guessing. Oh, if it's double digits, that's a crash. Oh, if it's 20%, that's a crash. Oh, if it's 30%, that's a crash. And we say that's all gobbledygook. That's all nonsense. A housing market correction happens all the time. They're regular events. We're in one right now. This is a housing market correction. Where a crash happens is where the existing housing stock under construction, is not absorbed when it is built. Now, what I mean to say by that is this. There are tens of thousands of condominiums that have been pre-sold to their new owners. A crash happens when those closings begin to fail, which are effectively foreclosures. They really are just another form of foreclosure in early stage. When those homes are completed and they're not owned, they're sitting there vacant because they haven't been closed upon, and lawsuits ensue, that is actually a crash. That is a crashed housing market. A correction can be 10, 15, 20, 25% of prices. You're seeing in Vancouver, you already have houses all over that are 30 and 40%. Economists at any of the banks saying the housing market is crashing. You also hear the local real estate board saying, well, prices are down 8% on single detached homes. Hogwash. They're down 30, 40, 50%, depending on the quality of the home that you're looking at. And now the condominium sector is being impacted by it. I mean, in all fairness, Jim, in British Columbia right now, you are basically back to 2014 prices. I don't care what anybody says. I would not spend more than 2014 prices on any property if I was forced to buy into this market. In Ontario, we're back to 2015 prices. And very quickly, later this fall, we'll be back to 2014 prices. What I hope you listeners understand from listening to us here in the show, housing markets are a beautiful thing. They move so precisely. They move with such surety that there is no reason ever to make a mistake. A housing market tells you so far in advance what tomorrow is going to be that there's no way that you can make a mistake. You can't put yourself in any risk. And then the flip side is, if you are already owning a home and you're worried about your home deflating in value, all you need to do is say, is my home going to be worth more than what it's worth today, 20 years from now, 15 years from now, 10 years from now? And if the answer is yes, you have no risk. If you say, 10 years from now it may be worth 10% less, okay, I'm still going to tell you there is no risk in that determination, because you've lived in a home that you haven't been kicked out of, that you've been able to set down roots, that you've been able to paint any color that you want, you've been able to put any kind of flooring down that you want, you've been able to put nails in the wall without worrying about a landlord telling you can't do it. There's great value in that. So the housing correction and the housing crash discussion really must end. We are in a full-blown housing correction in Canada. If a crash is going to take place, we will know that a year in advance. There's no way around it. Housing prices are already, in both the Greater Toronto area and the Greater Vancouver area, down 30 to 40 to 50%, depending on the home that we're talking about. And more in some cases. The higher priced homes have more flexibility because the owners of those homes have seen the highest increases. We looked at some stats this week where people who could have sold in 2016 in Vancouver who didn't, who have sold this year, who technically have absorbed a substantial loss because they didn't sell in spring of 2016. They weren't members. They weren't getting our advice back then. They came to us way too late. And now they're getting our advice and they're having to react because of their age, blah, 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 blah. There is no need to worry. The beautiful thing about homeownership is that you don't have to worry. All you need to do, get the numbers, understand what the numbers are, go talk to some other financial experts, get their opinion on whether the numbers that you have are correct or not. And after a team of people have told you, oh yeah, that looks like it's the way it's going to be, you make a rational decision. There's no need to panic. There's no need to rush into a market. There's no need to rush out of a market. The housing market is on the path that it's on. It's on a set of railroad tracks. It isn't going off the track. If it's going to go off the track, crash, we'll know that a year in advance. So don't worry.
Ross, thank you so much for chatting with us.
Hey, thanks for having me on, Jim.
My guest has been Ross Kay, home ownership consultant at thewealthyhomeowner.ca. If you have any questions for Ross, you can send them to info@housestreet.com. Find us on Twitter @HouseStreet, our YouTube channel, Talk Digital Network. I'm Jim Goddard. Thank you for listening.
Comments made on HouseStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HouseStreet.com radio is a production of House Street Media Incorporated.